Today we're tackling one of the biggest questions in the UK property market right now. With interest rates high and the cost of living spiralling, is buy-to-let still worth it? You've seen the headlines, the mortgage rates are up, tenants get squeezed, prices are rising everywhere. But what does the real data say for landlords and investors? Over the next few minutes I'll walk you through what's changed on mortgage rates and yields, how rent inflation and costs are squeezing cash flow, what happens if the rates rise another 1 to 2%, and whether there are still good deals out there or if BTL is broken forever. If we look at this graph, we can see that in 2023 to 2024, we saw BTL mortgage rates rocketing, with many landlords paying 5 to 6%. I myself did suffer from this. I had a property that came out of a 5-year fixed mortgage, and the monthly payments went from about $440 a month to $1,700 a month. I've got another video on this channel that shows how I dealt with this very intense situation. But as of Q2 in 2025, the average new BTL loan rate is around 5%, which is a huge burden compared to the 2 to 3% rates that were bought in a few years ago, which means your mortgage costs have jumped, and that changes everything. On the income side, the rents have risen too. According to 2025 data, the average rent for new lets in the UK is around $1,300 a month. This sounds good, but then you have to bear in mind that you also have inflation, higher energy bills, maintenance, tax increases, and these all eat into what you take home as a landlord. That means even if the gross yield, rent or purchase price looks decent, your net yield, which takes into account all the costs, shrinks fast. In some cases you're being forced to charge higher rent just to stay break even, but that pushes affordability for tenants, which reduces demand. UK Finance reports that the average gross BTL yield is about 7.2% in Q2 of 2025. This is actually up from the 6.9% we saw last year. So yield looks healthy until you add mortgage interest, maintenance, voids, taxes, compliance, landlord costs. If your mortgage rates go up by 1 or 2%, then suddenly that 8% yield might be wiped out. Even the ICR, which is the interest cover ratio, the measure that lenders use to check if the rent covers the mortgage, remains under pressure, meaning that many landlords are just about breaking even or getting squeezed, which is drastically different from the scenario we saw some years ago. If we do a quick stress test, then suppose you've got a property on a 75% LTV with a mortgage, and rent to yield looks good at about 8%. If your rate goes up by 1%, cost might swallow half of your profit. If it goes up 2%, many landlords end up operating at a loss. That's why when you buy or remortgage, you should always build a cushion. Plan as if rates are going to rise, not fall. From the tenant side, higher bills, inflation, stagnant wages, many renters are already strapped. For landlords, that means there's a real risk. Rents may not rise to match costs. If demand weakens or tenants struggle to pay, you face voids, arrears, or you have to lower rent, which further squeezes returns. Despite the squeeze, many landlords are still buying. UK Finance data shows there are almost 50,000 new loans in Q2 of 2025 alone. Some are targeting higher yield regions, cheaper areas, or shared houses to try to keep cash flow positive. So yes, the market is tougher, but for savvy investors who run the numbers properly and buy in the right areas, there are still deals to be found. So where does that leave us in 2025? Gross yields might look good, but interest rates and cost of living create real pressure on cash flow. Rent increases are possible but not guaranteed. Anyone buying or remortgaging right now must stress test for worst case scenarios, +1 or +2% rates. If you buy carefully, pick the right area and expect volatility, then BTL can still work, but it's no longer passive or easy money. So when investing, it's always best to run the worst case scenario, which takes into account rates plus inflation plus voids. Buy deals that work even under pressure. Thirdly, keep a buffer. Expect surprises. Fourthly, don't focus just on yield. Think long-term cash flow, sustainability, capital appreciation. Try to look at the whole picture and not just what's working now. So comment below, are you fleeing the squeeze or are you stacking deals? Subscribe if you want more real-world landlord truth and not just the hype. Thanks for listening. See you again.